In 1983, an unusual ad appeared in the Wall Street Journal. It wasn't promising riches from a hot stock tip, nor was it peddling a get-rich-quick scheme. Instead, it was an open invitation that would change trading history forever. Richard Dennis, already a legend in the futures pits of Chicago, announced that he would accept applications for a position few could have imagined. He would teach ordinary people his exact trading system, then fund them with real capital to prove it worked. The ad stated clearly, successful candidates would not trade for themselves, but for Dennis alone, and they would be paid a percentage of the profits they generated. Prior experience wasn't necessary. The only requirement? A resume and a 10-word answer to the question, "What makes you tick?" Over 1,000 people replied. Bankers, blackjack dealers, taxi drivers, PhDs, even high school dropouts. Dreamers from every walk of life wrote in, hoping to be chosen. Dennis, the man who had turned a borrowed $1,600 stake into over $200 million, had promised to reveal his method to a select few. When the list was finalized, just 23 applicants made the cut. Within 4 years, they collectively earned more than $100 million. There was Curtis Faith, only 19, who would make $31.5 million by the age of 23. There was Jerry Parker, a quiet accountant destined to manage billions. There was Liz Sheol, one of the rare women in the group, who would retire wealthy at 45. And there was Mike Carr, who transformed a modest government salary into generational fortune. None were born prodigies, and none were heirs to Wall Street dynasties. They became known instead by a single name, the Turtles. Their story remains one of the greatest experiments in financial history, a living testament to the idea that discipline, not destiny, defines success. Picture Chicago, 1983. In a dimly lit restaurant called the Colonial, two men leaned across a table scattered with wine glasses and unfinished meals. Richard Dennis, just 34, but already a legend, had turned a borrowed $1,600 into a fortune of over $200 million. They called him the Prince of the Pit. Facing him was William Eckhart, his closest friend and partner, a sharp mathematician and chess master. Their voices rose above the soft jazz. Eckhart argued with conviction. Trading can't be taught. You either have it or you don't. It's like perfect pitch or natural athleticism. Dennis leaned back, calm, amused. I disagree. Trading is a skill, not a gift. I could teach anyone to do what I do. The debate sharpened. Eckhart jabbed his fork, insisting Dennis was a savant who sensed rhythms others couldn't. Dennis smiled, eyes steady. Let's settle this. I'll prove it with an experiment. I'll teach ordinary people my system, and they'll trade it to success. It wasn't about money anymore. It was about reputation, about proving that greatness could be grown, not born. That wager would set the stage for one of the most extraordinary experiments in financial history. Applications poured in from every corner of America. Doctors weary of long hours, lawyers tired of endless cases, gamblers seeking a legal high, even housewives searching for independence. Richard Dennis and William Eckhart sifted through stacks of resumes late into the night. They weren't hunting for finance experts or seasoned traders. Dennis wanted blank slates, people who could follow rules without baggage. The criteria were unconventional. Could a candidate accept being wrong 60% of the time? Did they understand probability mattered more than prediction? Were they comfortable obeying rules instead of intuition? Most stumbled at a single question. If you had a 55% chance to win $1,000 or a 45% chance to lose $1,000, would you take the bet? Half the applicants said no, focusing on loss rather than expectancy. Dennis was looking for the ones who said yes. From more than 1,000 hopefuls, 40 advanced to interviews. Each brought a distinct flavor. Michael Cavallo, a 31-year-old government auditor who had never owned a stock, said simply, "I like rules. Tell me the rules, and I'll follow." Jerry Parker, a quiet 33-year-old accountant, admitted, "I'm tired of making others rich. I want systematic wealth, not random salary." Then came Curtis Faith, just 19, the youngest applicant. "Trading is code," he explained. "If, then statements with money attached. I can do that." There was also Liz Shyol, who had spent years fetching coffee for traders while watching them make fortunes. "I know I can do what they do. I just need someone to teach me," she said with conviction. And Jim Melnick, a sound engineer, whose answer to "What makes you tick?" was solving puzzles nobody else can. After grueling interviews, 23 were chosen. They would soon walk into the most intense classroom of their lives. Dennis called them his turtles, inspired by a farm he had seen in Singapore. "We're going to grow traders like they grow turtles, slowly, systematically, and perfectly." January 1984. The Chicago Board of Trade Building. 23 nervous recruits filed into a stark conference room, notebooks clutched, hearts racing. Richard Dennis entered without fanfare, his presence commanding immediate silence. He scanned the room and began. "Forget everything you think you know about markets. Your opinions are worthless. Predictions are garbage. Intuition is your enemy." The words stunned them. Many had expected secrets of hidden patterns or insider tricks. Instead, Dennis dismantled every illusion. "We're going to buy high and sell higher. We're going to sell low and cover lower. We will lose money 60% of the time and still get rich." One of the recruits, Michael Cavallo, raised his hand. "But isn't the goal to buy low and sell high?" Dennis smiled. "That's what everyone believes. That's why everyone loses. We're not investors chasing bargains. We are traders riding trends. Big difference." He turned to a whiteboard and began writing what he called the complete turtle trading system. It fit neatly onto the board. Entry rules. System 1. Buy 20-day breakout. Exit at 10-day low. System 2. Buy 55-day breakout. Exit at 20-day low. Add units as profits grow. Exit rules. Initial stop. 2 times average true range. Exit on 10 or 20-day reversal. Never move. Stops further away. Position sizing. Unit size equals 1% of account, adjusted by volatility markets. Bonds. currencies, commodities, indices, everything liquid. That's it. Dennis concluded, this is the system that made me $200 million. But knowing the recipe doesn't make you a chef. Execution is the difference. Curtis Faith scribbled notes furiously, then asked, what about news or economic reports? Dennis shook his head. Worthless. Price already reflects all information better than you ever could. For hours, he tore apart sacred ideas, technical patterns, fundamentals, predictions, discretionary hunches, all branded as traps. By the day's end, the turtles' minds were reeling. The myths were gone. In their place stood a simple, systematic truth. Day 2 of turtle training began with Richard Dennis carrying 2 briefcases into the room. He placed them on the table with deliberate weight. One of these contains the reason most traders go broke, he said. The other contains the secret to getting rich. Can anyone guess which is which? The room was silent. He opened the first. Stacks of charts, indicators, and complex analysis. This is what most traders obsess over. Entries, worth maybe 10% of success. Then he opened the second, a single sheet of paper with one formula. Position size equals account times risk percentage divided by volatility. This, Dennis declared, is 90% of success. He turned to the whiteboard and illustrated with examples. Trader A, the amateur, has a $100,000 account. He buys 10 gold contracts because he feels confident. Gold drops by normal volatility. He loses half his account. Trader B, the turtle, sizes properly, loses only 2%. Same move, opposite outcome. The recruits leaned forward. Mike Carr raised a hand. But what if the amateur was right? Gold rises. Dennis smiled. Then he doubles his account. Looks good, until one bad trade wipes him out. Over time, random sizing destroys. Systematic sizing wins. He drew the math across 100 trades. The amateur doubled, then blew up. The turtle, with smaller, consistent bets, compounded steadily until the account doubled without ruin. The lesson sank in. Position sizing wasn't risk management. It was the strategy itself. Dennis went deeper, teaching the N calculation. Average true range of volatility. Sugar might swing $500 per day. Bonds, $300. You didn't risk the same dollars. You risked the same percentage by adjusting size. The market tells you how much to trade, he said. And when you're winning, you add. Some minds tried to complicate it. Dennis warned. That resistance you feel, that's ego. If making money is this simple, what have you been doing all this time? Day 3 of training, Richard Dennis leaned against the whiteboard and asked, who can tell me the fastest way to go broke? One recruit guessed averaging down. Dennis nodded slightly, then delivered the truth. The fastest way is adding to losers. The fastest way to get rich is adding to winners. We call it pyramiding. The class shifted uneasily. They had heard cut losses, let winners run, but actually increasing bets as prices rose seemed reckless. Dennis drew two examples. First, the traditional trader. Buy 10 units at $100. Sell at $110 from fear of giving back gains, missing the move to $150. Then the turtle method. Buy 10 at $100. Add 8 more as price climbs. Then 6. Then 4. Until the position swelled profitably. Same initial risk. 5 times the profit. Jerry Parker raised an objection. But what if it reverses after we pyramid? Dennis smiled, showing the math. Even if the last editions lost, the earlier ones locked in gains, leaving a net profit. The recruits were stunned, but Dennis warned them. Pyramiding only works in true trends, and trends are rare. Most of the time, they would be losing small, waiting patiently. Can you handle being wrong most of the time? He asked. Their silence was answer enough. 2 weeks of training ended, and now came the real test. January 16th, 1984. The Turtles were handed live accounts. Some of you will trade with $250,000, others with $1 million, a few with $2 million, Dennis announced. This isn't play money. Lose it, and it's gone. Curtis Faith, only 19, was stunned when Dennis pulled him aside. You're getting $2 million, Dennis told him. Faith whispered, Why me? Dennis replied, Because you have no bad habits to break, and you ask the best questions. The first week was brutal. Most lost money. Jim Melnick wrote in his journal, soybeans stopped out. Swiss francs stopped out. Crude oil stopped out. Down $47,000 in 5 days. The system feels broken. The emotional toll was heavier than the financial. Some reduced position sizes. A few skipped trades entirely. Then, on February 8th, heating oil broke out. Every turtle got the same signal, but their choices diverged. The faithful took full positions. Curtis Faith loaded 15 contracts. Jerry Parker took 12. Paul Rabar 10. The cautious traded half size. 2 skipped entirely. Heating oil surged from 94 cents to $1.28 over 3 months. Curtis Faith, pyramiding relentlessly, made $3.2 million. Jerry Parker earned $1.8 million. The half-sizers made only hundreds of thousands. The skippers made nothing except regret. At the quarterly review, Dennis was blunt. The traders who followed the system made millions. The ones who let discretion interfere made scraps. Discipline is the difference. For the turtles, the lesson was seared into memory. Knowing the rules wasn't enough. Trusting them under fire was what turned capital into fortune. March 1984 brought an abrupt shift. The heating oil trend was finished, and now came the grind. 4 months of sideways markets where every breakout failed. The turtles logged loss after loss. 19 of 23 trades down in March. 24 of 31 in April. Nearly the same in May and June. The numbers were painful, but the psychology was worse. Paul Rabar admitted, "I woke up each morning knowing I'd probably lose money. The weight was crushing." Tom Shanks built a ritual, forcing himself to write the system works 10 times daily to stay sane. Liz Schiol taped over her P&L column, allowing herself to check only on Fridays. Otherwise, the despair was too much. Some cracked. David Schiol, no relation to Liz, began improving the system, skipping signals that looked weak, reducing size when markets felt too volatile. By July, his losses were smaller, down 8% versus minus 15 for the purists. He felt vindicated. But then August arrived. Coffee exploded. Sugar rallied. Currencies trended. The disciplined turtles surged 40 to 60%. Curtis Faith alone made $4.7 million. David, trading half size and skipping entries, made only 5%. The lesson was brutal. Optimizing for comfort meant missing fortune. Even success carried demons. Jim Melnick confessed he couldn't sleep. Not from losses, but from the guilt of sudden wealth. "I was making more in a day than my father made in a year," he said. "It felt undeserved, like luck." In a group session, Dennis cut through their turmoil. "The market doesn't care if you deserve it. It only cares if you followed the rules. Your job is not to be worthy. It's to be systematic." September 12th, 1984. Jim Melnick made the error that would haunt him. While calculating position size for Deutsche Marks, he multiplied wrong and bought twice what he should have. By the time he noticed, the market was already moving against him. Each tick meant a $15,000 loss. And his account was suddenly down $450,000. His first instinct was to panic, close the trade, take the loss, and hide. But then he remembered the system. The stop hadn't been hit. The rule was clear: hold. For 2 agonizing weeks, Melnick barely ate or slept, his screen a blur of red. Then, on day 14, the Deutsche Mark broke out upward. The error became his biggest winner of the year. $1.8 million profit. "I got lucky," Melnick admitted later. But it proved even mistakes can be redeemed by discipline. Dennis turned the lesson into gospel. The first bad decision was a mistake, but the second, sticking to rules, was wisdom. Not all errors ended well. Philip Liu, an MIT graduate with sky-high IQ, decided he could improve the turtle system. He added filters, only trade breakouts with volume, skip overextended markets, reduce size when volatility spiked. Every tweak made logical sense. But quarter after quarter, his performance lagged. While disciplined turtles posted 40% gains, Liu scraped out single digits. By early 1985, he quit, exhausted and bitter. Dennis's verdict was sharp. Intelligence without discipline is worthless. Better to be a disciplined fool than an undisciplined genius. For the turtles, Melnick and Liu became twin cautionary tales. One who stumbled into fortune by obeying the system even after error, and one who sabotaged himself by trying to be smarter than the rules. October 19th, 1987. The day markets went insane. Tom Shanks walked into the office that morning up $10 million for the year. By mid-morning, the Dow wasn't just falling. It was collapsing. 10%, then 15, then 20. Phones rang. Brokers screamed. Traders panicked. Shanks was short S and P futures, but the market went limit down. His stops were useless. Within hours, his profit had swung to a $3 million loss. "I went to the bathroom and threw up," he later admitted. Then he returned to his desk, shaken, but still scanning for the next signal. Jerry Parker faced the same storm from another angle. Perfectly positioned, he was short indices, long gold and yen. While chaos reigned, his system delivered a net $5 million gain. "It felt like the eye of a hurricane," he said. "Everything crumbling, but the rules held steady." The real test came the next morning. Shanks, still reeling from a $13 million swing, got a new signal: buy gold. Every instinct screamed, no, take a break, retreat, protect the wounds. But the system was clear. He obeyed. Gold rallied 8% in 2 weeks. By year's end, Shanks had recovered, finishing up $3 million. "If I'd stopped trading after Black Monday," he reflected, "I would have locked in disaster. Following the rules saved me." Curtis Faith put it bluntly. Black Monday wasn't a disaster. It was a filter. It revealed who traded by emotion and who traded by system. For the turtles, the crash became a crucible. The market's violence wasn't the real enemy. It was fear. And discipline was the only shield strong enough to survive it. By 1988, the experiment was over. Richard Dennis had proved his point. Great traders could be made, not born. But when the classroom doors closed, the turtles scattered in every direction, each carrying the DNA of systematic trading into their own future. Jerry Parker went big. He founded Chesapeake Capital, raised institutional money, and built a billion-dollar fund that weathered crises for decades. "Dennis taught us more than trading," he later said. "He taught us how to build systems that work without us. That's the real fortune." Curtis Faith went deep. He wrote the definitive book on turtle trading, teaching thousands. "My edge wasn't hiding the secrets," he explained. "My edge was showing that even when the rules were public, few could execute them." Paul Rabber went pure. He kept trading the exact same system from 1983. No modifications, no filters, no embellishments. For decades, he quietly compounded returns. "Why change what works?" he asked. "The market changes, but math doesn't." Others sought freedom. Liz Shiowal retired at 45, using her millions to design the life she wanted. "Trading gave me freedom," she reflected. But freedom from trading was the real gift. Mike Carr applied turtle principles beyond markets, into real estate, businesses, and stocks. Building an empire rooted in systematic thinking. "Once you see the world as systems," he said, "you can't unsee it." Not everyone thrived. Some cracked under wealth's weight, addictions, divorces, burnout. "We were trained to make money," one admitted. "Nobody trained us for what came after." Michael Cavallo chose the quiet path. No funds, no interviews, just private, disciplined wealth building. His estimated net worth, $400 million. A few innovated, adapting the DNA to new frontiers. Shorter time frames, option overlays, even cryptocurrency. But the thread remained: systematic entries, mathematical position sizing, disciplined exits. The diaspora proved a deeper lesson. The system was universal, but expression was personal. By 2011, the whispers had grown into obituaries. Financial media, academics, even former believers declared it. Trend following was dead. Central banks were crushing volatility with endless money printing. Correlations rose toward one. The clean, sweeping moves that had built turtle fortunes seemed to vanish into endless chop. Jerry Parker's Chesapeake Capital, a giant of systematic trading, suddenly faltered. Minus 11% in 2011. Minus 8% in 2012. A small gain in 2013. Another stumble in 2014, 2016. Assets under management shrank from $1.5 billion to just $400 million. Emails poured in. You've lost your touch. AI has killed trends. The game is over. The pressure to adapt was immense. Shorter time frames, central bank filters, overlays of discretion. Investors begged him to modernize. Parker refused. Nothing changes, he said. The hardest trade is staying systematic when systematic isn't working. Others face the same torment. Paul Rabar endured brutal drawdowns while investors pleaded for innovation. He answered with the same words: the system doesn't need to change. Our patience does. Some turtles gave in, tinkering with tighter stops and filters. Others abandoned trend, following altogether, chasing value, arbitrage, or quitting entirely. But the faithful held on. Through the barren years they waited, logging small losses, their conviction tested. Then, in 2020, the dam broke. Pandemic chaos and central bank explosions unleashed violent, beautiful trends. Parker's Chesapeake roared back, plus 38% in 2020, plus 29% in 2021, plus 35% in 2022. The adapters, optimized for drought, missed the flood. The lesson was brutal and clear. Systems don't fail. Patience does. They never met Richard Dennis, never sat in that Chicago classroom, but the second generation of turtles might be even more successful than the originals. They learned through books, recordings, and, if they were lucky, direct mentorship from the first wave. What they lacked in origin myth, they made up for in reach. Salem Abraham was one of the first. In 1988, a Canadian grain elevator operator with just $50,000 and a dream, he read about Jerry Parker's success and made a bold call. "I'll work for free," he told Parker. "Just let me watch." Parker agreed. Abraham slept on a friend's couch for months, absorbing not just rules but mindset. "The market taught me patience," he recalled, but Parker taught me discipline. Today, Abraham's Fortress Capital manages $500 million. Kevin Bruce followed a different path. Learning from Paul Rabar in the 1990s, he narrowed his focus to commodities. They trend cleaner, less manipulated, he explained. Starting with $200,000, he grew into a $300 million manager. Elizabeth Schiole, daughter of Liz, chose depth over breadth. While her mother had traded across many markets, she focused on just 3 stock indexes, compounding at 22% annually since 2001. Specialization is my edge, she said. Then came Marcus Chen, a protege of Curtis Faith. He applied turtle DNA to cryptocurrency in 2016, when others called it chaos. Volatility is what we trade, Chen laughed. He adapted for 24/7 markets, shorter lookbacks, and extreme swings. In 5 years, he turned $500,000 into $50 million. What made this second generation special wasn't just their results, it was their openness. Abraham shared on podcasts, Bruce on YouTube, Chen through open source frameworks, and Elizabeth through mentorship for women in trading. The first generation proved it worked. The second proved it was timeless. And they knew the third would prove it universal. If Richard Dennis could see a turtle's trading setup today, he'd laugh and then adopt it instantly. The rules are unchanged, but the tools look like science fiction. In 1983, the reality was crude. Quote machines cost $2,000 a month. Orders were phoned to brokers on the floor. Position sizes were calculated by hand on paper, with errors costing fortunes. Reports came the next day. Tom Shanks remembered. I'd spend 2 hours just calculating signals, another hour sizing positions. One math slip could wipe you out. By 2024, the transformation was astonishing. Salem Abraham's command center looks like NASA mission control. 6 glowing monitors, 50 markets updating in real time, automated signal calculation, one-click position sizing, cloud backups. What took Dennis hours takes minutes, yet the debates remain. How much should be automated? Kevin Bruce is all in. The computer has no emotions. Perfect execution every time. Jerry Parker resists. I want to feel the click. That's where discipline lives. Abraham found a hybrid path. Signals and sizing automated. Entries confirmed by hand. Even trading locations transformed. Marcus Chen runs crypto trades from a phone app on a beach in Thailand. His custom alerts and auto-exit scripts make million-dollar decisions portable. But new dangers emerged. Over-optimization, torturing data until it lies, information overload, Twitter, CNBC, infinite noise, speed addiction, mistaking fast trades for better ones. Through it all, one timeless truth remained. Paul Rabar still keeps his 1983 calculator on his desk. It still works, he shrugs. All my fancy computers just do the same math faster. The edge isn't the platform. It's the discipline to use it. Marcus Chen pitched the idea in Curtis Faith's living room. and it sounded insane. Crypto is the perfect turtle market, he said. Faith frowned. It's unregulated, manipulated. It could vanish. Chen grinned. So was silver when the Hunts cornered it. Volatility is what we trade. In 2016, Chen began applying turtle rules to digital assets. Crypto was open 24/7, retail-driven, wildly inefficient. There were no gaps, only endless motion. He shortened lookbacks, reduced position sizes, skipped pyramiding at first, starting with $500,000. His life savings plus family loans. He committed to pure systematic discipline. The results were staggering. 2017's boom saw Bitcoin up 400%, Ethereum up 1,000%. Chen's signals fired relentlessly. His account surged 900%. It felt too easy, he admitted. But he remembered turtle history. After every frenzy comes a desert. The crash arrived in 2018. Bitcoin plunged 85%. Chen lost 47% that year, but survived, while buy and hold traders lost nearly everything. He refined core positions in Bitcoin and Ethereum, small allocations in liquid altcoins, strict exchange diversification, 50% of profits kept in fiat. By 2020, when COVID panic met money printing, the storm favored him. His system caught every breakout. Bitcoin from 5,000 to 65,000, Ethereum from 100 to 4,000, altcoins surging tenfold. By late 2021, his $500,000 had become $50 million. Same math as soybeans, he said. Then came 2022. Crypto collapsed, and Chen gave back 40%. But unlike others, he was positioned for the next cycle. Crypto traders think they're special, he said. They're making the same mistakes commodity guys made decades ago. For him, the lesson was clear. Human behavior repeats. Volatility is opportunity if sized correctly. Mania and panic are the fuel. Whether soybeans or Dogecoin, the emotions are identical. The edge isn't new, Chen told his students. It's timeless. Curtis Faith stood before a room of aspiring traders in 2019, 3 decades after his turtle days, and told them something surprising. The real test wasn't in the first 10 trades, but in the first 100. Anyone can follow rules for 10 trades, he said, maybe even 20. But somewhere between 20 and 100, the real you shows up. He explained the phases like a map. Trades 1 to 10, the honeymoon. Confidence high, enthusiasm bubbling, often with lucky profits. Trades 11 to 30, the first sting. A losing streak hits, and 70% start bending rules. Trades 31 to 50, the fork. Drawdowns bite. Half quit. Some chase a new system. A few endure. Trades 51 to 75, the darkness. Longest losing streaks test your core. Only 10% stick. Trades 76 to 100, the transformation. A breakthrough trend appears. Discipline becomes habit. Systematic thinking takes root. Faith gave his students a challenge. Survive 100 trades with perfect discipline. He laid out a protocol. Step 1. Write your rules on a single page. Entries, exits, position sizing. Step 2. Track everything. Signals, emotions, violations. Step 3. Fund an account with tuition money, an amount you can lose without fear. He showed them examples. Maria Gonzalez, a Spanish teacher, followed rules for 20 trades, broke them for 20, nearly quit, then recommitted. By trade 100, she was up 23%, but more importantly, transformed. James Park, an engineer from Korea, kept flawless discipline until trade 88, when greed doubled his size. He lost 8% on one trade, but finished positive at plus 31%. That one mistake taught me more than 87 perfect trades, he said. Faith described the markers of transformation. By trade 100, successful traders report numbness to individual outcomes, automatic position sizing, comfort with being wrong, faith in long-term edge. You stop being a person who trades, Faith said. You become a system, one that happens to be human. Salim Abraham's alarm rings at 5:47 a.m., the same time every day for 15 years. He calls it his non-negotiable wake. No snooze, no excuses. The market doesn't have a snooze button, he tells friends. By 6, coffee in hand, he scans overnight moves across currencies, commodities, indices, and crypto. He isn't predicting, he's observing. Did anything hit a breakout? That's all he needs to know. At 6:30, a Python script runs position sizing, but Abraham still checks the math manually. This is where discipline lives or dies, he says. Natural gas flashes a buy signal. Account, $12 million. Risk, 1%. Contracts, 57. Most traders would round up. He never does. That kind of thinking leads to bankruptcy. Orders placed by 7:30. His actual work is finished in 12 minutes. The rest of the day is waiting. Workouts, reading, journaling, walks, meditation. Meanwhile, positions swing hundreds of thousands of dollars. Crude down $127,000. Euro up $89,000. Cotton up $43,000. An amateur would fiddle, read news, shift stops. Abraham goes for a walk. By 3 p.m., he reviews signals, tracks results, and shuts down. The market runs 24/7. I don't. His logbook shows only about 80 hours of active work a month, but 400 hours of waiting. That imbalance, he says, is where the edge hides. It isn't glamorous. Friends imagine exotic freedom. The reality is discipline, isolation, missed dinners, vacations cut short. Systematic trading isn't about excitement, Abraham reflects. It's about enduring terminal boredom while making life-changing money. In 2023, Jerry Parker grew tired of vague answers to the same question he received every week. How do I become a funded trader like the turtles? So he mapped it step by step, stripping away the myths. It's not about finding another Richard Dennis, he explained. It's about becoming someone worth funding. Phase 1 was building a track record, 2 years minimum. Start with $10,000. Less, and you can't trade properly. More, and you'll get careless. Trade systematically. Use third-party verification. Document everything. Year 1, maybe minus 10% to plus 30%. Year 2, consistency. Drawdowns of negative 20% are expected. Nobody cares about paper trading. Parker said, only real money counts. Phase 2 was business infrastructure. Between months 18 and 30, form an LLC or corporation, open accounts, hire a securities attorney, pass exams, and prepare for compliance. Expect $25,000 to $50,000 in setup and maintenance costs. This is where dreamers disappear, Parker said. The serious ones keep going. Phase 3 was finding the first million. Options included friends and family. Easy to get, hardest to keep. Seed capital firms, professional funding with revenue splits, or direct institutions. The hardest path, but best terms. Parker insisted on one thing: a simple pitch deck, track record, rules, risk management, drawdowns. No stories, no predictions, just results. Phase 4 was scale or fail. Half of new funds collapse in the first year. 80% fail within 3. Only 1% reach $1 billion. Parker listed the killers: changing systems during drawdowns, client psychology, burnout, compliance failures. Trade the same at $100 million as you do at $1 million. He warned. He shared the brutal math. Year 1, 2 million AUM, revenue $60,000, expenses $120,000, net loss. Year 3, $20 million AUM, $200,000 net. Year 5, 100 million AUM, 1.5 million net. Real money takes 5 years minimum, Parker said. Most quit at year 2. That's why they never run funds. In 2023, the surviving original turtles gathered for a rare reunion. The room carried the weight of 40 years. Billions earned, millions lost, and lessons that had outlived markets. One by one, they spoke, each voice sharpened by time. Curtis Faith began. If I could tell my 19-year-old self one thing, it would be this: the money is the easy part. Staying human is the challenge. Jerry Parker followed. I thought millions would solve everything. They didn't. Money amplifies who you are. If you're unhappy poor, you'll be unhappy rich. Paul Rabar smiled gently. I've traded the same system for 4 decades. People ask if I'm bored. I tell them no, I'm free. Free from prediction, free from stress, free from constant decisions. Liz Shyol shared her balance. The market taught me when to hold on and when to let go. That lesson saved both my account and my life. Mike Carr laughed softly. The first million felt exciting. The 10th made me anxious. The 20th made me philosophical. True wealth is knowing when enough is enough. Then came Tom Shanks, the veteran of Black Monday. I've lost more in a day than most people see in a lifetime, but I'm still here, still trading. Survival is success. Together, they distilled their wisdom. Markets trend only 30% of the time. Catching a few big ones is enough. Position sizing determines survival. Exits matter more than entries. And above all, discipline beats intelligence. Boring beats exciting. Process beats outcome. Life lessons followed just as sharp. Money amplifies. Balance prevents burnout. Teaching cements, learning, and everything, including trading, needs an exit strategy. Salim Abraham, representing the second generation, added, "The originals proved it worked. We proved it's timeless. The next generation will prove it's universal." Marcus Chen closed. Whether soybeans in 1983 or Bitcoin in 2023, the math is the same. Buy strength, sell weakness, size by volatility. Everything else is noise. Curtis Faith believed transformation had a timeline. "Give me 90 days of perfect discipline," he told students, "and I'll give you a lifetime of systematic thinking." He built a blueprint, not of abstract theory, but of daily habits designed to reshape both mind and market performance. Days 1 through 30 formed the foundation phase. Week 1, design your system in a single page. Entries, exits, position sizing, markets to trade. If it took more words, it was too complicated. Week 2, mental training, beginning with meditation and visualization. Week 3, paper trading with realistic accounts. Week 4, stress testing. Trade when tired. Trade when scared. Trade after losses. Proving the system could function regardless of mood. Days 31 to 60 became the execution phase. Students took signals without exception, sized positions mechanically, logged emotions and rule breaks. The honeymoon enthusiasm wore off, replaced by boredom, doubt, or temptation to adjust rules. But those who pushed through reached trade 50 and discovered their deepest patterns, skipping trades after losses, chasing missed ones, or shrinking size from fear. The spreadsheet never lied. The final stage, days 61 to 90, was integration, real money, small at first, then scaled with discipline. By trade 100, successful students no longer thought of themselves as people trading. They became trading systems in human form. Faith insisted on markers of transformation, 50 trades logged, expectancy proven, 0 emotional violations, a daily routine carved in stone. Stories poured in. A nurse who broke through on her 67th trade after 7 losses. An engineer who violated once on trade 88 and never again. Common failures were predictable. Quitting after paper trade losses, collapsing in boredom midway, or breaking discipline as soon as real money was involved. But those who endured emerged with something indestructible, a habit. 90 days to build it, 900 to build wealth, 9,000 to build legacy. Your only decision Faith concluded, is whether day one starts tomorrow or never. You've now absorbed the entire turtle journey. The ad in 1983, the bet, the rules, the psychology, the losses, the triumphs, the second and third generations, the modern tools, even the crypto experiments. Every story points to one truth. The system works. The only question left is not whether it works, but whether you will. Curtis Faith once revealed that Dennis didn't just teach trading, he taught trust. Trust in the math, trust in the process, trust in yourself to execute rules when your emotions are screaming the opposite. That is the final challenge. Trading isn't about discovering new edges. It's about committing to one that already exists and having the discipline to stay with it. Right now, markets are moving. Trends are forming. Somewhere, a systematic trader is taking the signal you just learned to recognize. They are not smarter than you, not luckier than you. They simply chose discipline over doubt. Every trade they take, every habit they reinforce, every loss they accept without flinching, moves them closer to generational wealth. Two paths stretch out before you. One is familiar. Search for the next secret. Bounce between strategies. Hope and despair on repeat. The other is harder, but certain. Follow the blueprint. Trade with discipline. Let compounding do the heavy lifting. Day one begins not in theory, but in action. Tonight, you can write your rules. Tomorrow, you can take your first trade. 90 trades later, you will no longer be dabbling. You will be transformed. The turtles proved it 40 years ago. Success did not belong to the chosen few. It belonged to those who acted. Now it's your turn. The market is waiting. The only missing piece is you.